What's up, apes? Welcome back to the 𝗪𝗚𝗀𝗀 podcast / video stream of the day. My name is David. Thank you all for joining us once again on this beautiful Monday, July 15th, 2024. It is currently 8:27 p.m. and boy, do we have a lot to talk about here today. So let's go ahead and get right into it. I do apologize as well that we didn't come out with a weekend edition. There was no podcast Monday morning. I was a little bit busy. I was actually, I spent my weekend on top of a roof at a Donald Trump rally in Pennsylvania. So then all of a sudden, everybody started kind of freaking out out of nowhere. I don't really know what was going on. I was just trying to watch through my scope, but, it wasn't particularly clear. Anyway, the WSO Alpha portfolio. This is our proprietary portfolio here at Wall Street Oasis, and you should definitely go ahead and sign up for it so that you can trade right alongside with us. We just published a 23-page report on a cannabis company, and we also just dropped a summary of BlackRock's earnings that we'll also be talking about a little bit later on here today. You're kind of getting the free version in the Daily Peel. Subscribe for the more advanced version over at WSO Alpha. There's plenty more charts and way less yapping going on over there. So make sure to sign up to make money and, in the case of today, to lose money alongside us. So we shed about 24 basis points in the portfolio here today. Solar stocks got absolutely beaten down like the market like they owed the market money or something. It was fucking insane how badly jumped they got. Enphase Energy is one of our newest purchases. Very tough day, but we'll talk about why in a second. That's one of our stock movers. Now, the S&P 500 was up 28 basis points for the session, whereas the NASDAQ was up approximately, if this ad ever goes away, the NASDAQ index was up somewhere around 40 basis points. Yeah, exactly at 40 basis points. I gotta just trust my memory. I'm literally the smartest person alive. I know absolutely everything, but still some underperformance from us. It was a decent day for big tech, especially coming off of a really lousy ending towards last week, so they started to rebuild on those gains a little bit. Now let's go ahead and move into some of the banana bits for the day. So first and foremost, Fed Chair Mr. Jerome Powell said the exact same thing that he's been saying. I don't know why this guy has been yapping so much lately, from Congress to central bank conferences to whatever the fuck he was doing today. He came out and said the exact same thing that he's been saying. We're going to cut rates. We have no idea when. Everybody have a good night. Like, that was basically it. The market kind of doesn't even care anymore because it's already being priced in, because everybody and their mother knows that there's going to be rate cuts at some point, but we have no idea when. My personal hot take of the day, they're coming in July. They're going to come at the end of this month. It's going to be quite a shocker to the upside, especially for small caps. And that leads us into our next banana bit, because small cap fund inflows, they reached a high since December last week. So this was the highest amount of inflows into a small cap fund that we've seen since December. And that kind of makes sense because investors tend to pour into small caps when we're entering a declining rate environment. So small cap stocks, they're much riskier to lend money to because they're small cap stocks. And so a lot of the time they either get higher interest rates or floating rate. So that means it's not going to be pegged for 30 years like every loan that Apple has is going to be. That's why all these companies, the large companies, gorging on debt in 2020 and 2021 when interest rates were through the fucking floor. Small cap stocks are much more exposed to floating rates. So when those interest rates decline, so are their interest payments that they're going to have to make. So investors love to see shit like that. Next up, 48 hours after getting shot at a rally in Pennsylvania this weekend, former president and current Republican frontrunner, I should probably just say future president at this point, he selected his vice president, Mr. J.D. Vance. I don't know anything at all about him. I know he's a senator from Ohio and he looks like a lesbian, but that is all that I know about him whatsoever. Moving on down below, digital asset funds saw their 5th largest inflows for any week ever last week. And I mean, that's not really saying a whole lot because they haven't really been around too long unless you count Grayscale, but that was a trust. So I don't count it because it's a trust and I don't trust it. Anyway, moving on down into our final story of the day. They're doing a lot of investigations into this kid that tried to shoot Donald Trump, the 20-year-old fucking, I forget what his name was, like Thomas Cooks or something like that. They're doing a lot of investigation into that, and it turns out he has literally no internet presence whatsoever. He had no motivations, apparently, to shoot Donald Trump. They can't figure out anything why he may have done this, or at least that's what they're telling us. It's similar to the amount of information that they're giving us about, like the Jeffrey Epstein files or the Kennedy assassination back in 1963. Like, what the hell is the babushka lady doing there? You know what I mean? So they're basically giving us the exact same amount of information there. I think we can all figure out what that means, but I don't want to be the next person to get shot. So let's go ahead and move into our macro monkey story of the day. We are, of course, checking in on China here today because it's been a while since we checked in on China. So it's time for their regularly scheduled checkup. And I regretted it immediately. It was a terrible experience going through all this stuff. The amount of virus warnings that you get on your computer when you're trying to open up national data from China is somewhat concerning. concerning. Now I'm a little bit worried about my identity being stolen, but we did it all for you because we got to bring you guys the hard-hitting facts of the day. And of course, yesterday it was all about China's GDP growth. So let's go ahead and see how that went. Well, it went exactly how this chart looks right here. What you're seeing is the annualized growth rate by a quarter for the Chinese economy. As we can see, it's been a little bit wobbly-woozy over the past 5 years or so. But in the second quarter of 2024, China's national GDP increased at an annualized rate of 4.7%. Here in the United States, that day would become a new fucking national holiday, the day that we learned about that. But over in China, it's absolute crap. They track a 5% GDP growth target rate, just like similar to how the Federal Reserve tracks like 2% inflation. It's basically similar because nobody knows why that's the target. For China, it's probably the exact same reason. 6% is too high, 4% is too low. Very much like why the Fed targets 2%. But nonetheless, it was pretty unusual for China to come in below that target, especially this week when they are doing there's a major economic event going on in China right now. Basically, every 5 years, they hold this event that's called the 𝗪𝗲𝗀𝗀𝗪. Turns out this isn't just the third one. I don't know why it's called the 𝗪𝗲𝗀𝗀𝗪, but apparently this is basically like a 5-year meeting that occurs every 5 years so China can plan out its economy and other aspects of world domination over the next 5 years or so, and can kind of update its long-term, like century-long plan that they do. So it's a little bit interesting to see this data coming out during the same time. It's also interesting that China usually has a press conference when this kind of data comes out from the National Bureau of Statistics. They usually have a press conference. They did not do one yesterday. That's probably because they're worried about the 𝗪𝗲𝗀𝗀𝗪 instead of, some bullshit fucking quarterly GDP growth rate. But nonetheless, analysts were a little bit concerned by it because it's unusual behavior. It might show that they're kind of trying to hide from this shit. But nonetheless, China wouldn't hide from, data. They wouldn't try to cover things up and make them seem better than they are. No, the CCP would never do anything like that. So who knows what actually happened. Either way, overall GDP grew at 4.7%. Consumer spending was a big detractor on the report. Let's go ahead and go to the chart right here. So it was the first time that consumer spending has declined on a monthly basis since July of 2023. Very similar to the exact same data that we saw in the United States for the month of June, except in China, consumer spending doesn't really pack as much of a punch as it does here in the United States. So first and foremost, spending fell 0.11% or 11 basis points. So one, not a huge decline whatsoever. It's about the same. The US, it was 0.1% as well. So, not really anything to get too riled up about, but especially in China because consumer spending in the Chinese economy tends to drive about 50 to 53% of GDP. Here in the United States, we're on steroids. It's about 60 to 70% of GDP, or more like 65 to 70%. It's typically around the 2/3 line for us here in the US. That's why we tweak about it so fucking much. But in China, they're more worried about things like fixed investment and property investment. Now, those were kind of pulling in opposite direction. So fixed investment was looking good. Property investment was absolutely not. So, the property market is still kind of absolutely in shambles. That's going to be a big focus of the 𝗪𝗲𝗀𝗪𝗪 going forward. Quite honestly, they got a lot of work to do over in China. Those the CCP members that are in charge of running the economy, they have quite a lot of work to do, especially when they have this lurking in the background of their economy. So for those listening to the podcast, what we're seeing here is somehow a chart from The Economist that I was able to see without paying for a subscription. Don't know how. But what we're seeing here is the GDP deflator in China. The GDP deflator, for those that don't know, is effectively it's basically a measure of inflation, economy-wide inflation. That's kind of all you need to know. So when it goes negative, it is officially in deflation territory. This has been negative for at least the past year or so. So China has been experiencing deflation, and that goes right hand in hand with declines in consumer spending. Consumer spending declines are a symptom of deflation because consumers think, well, prices are falling, they're going to be cheaper next month, so I might as well just wait until next month to purchase them. And then next month comes, and if it's not an essential item, you're like, I'll just wait another month. And everybody stops spending, and that's how you enter a recession, economic collapse, Great Depression, all that bullshit. So with this in the background, China really has to do something fast. Now, the central bank can do quite a bit over there. They can lower interest rates. They can increase asset purchases. They can fucking force all the 80-year-olds to go work in a fucking labor factory if they really wanted to. If they wanted to really pump the jets, they absolutely could do something like that. I'm kind of surprised they haven't already. But nonetheless, there is a lot of work to do over in China. It's still one of the fastest growing economies. Well, the fastest growing developed economy. I think China is still considered a developing economy, or as if it's not on the same par as the United States or the UK or Germany or something like that. But nonetheless, it is definitely one of the largest and most quickly growing economies in the entire world. So it's not like this is, the doom of China or anything. It's going to take a hell of a lot more than that. But I really just hope that they come up with a better name for this annual, or, whatever it would be, every 5-year economic event in the 𝗪𝗏𝗏𝗀. Just makes me think of boogers. And when I'm trying to think of macro, I really don't want to think about what I'm doing while I'm reading stories about macroeconomics. Anyway, let's go ahead and move on into our stock movers. So first and foremost, we had to do it. Trump Media and Technology Group. Do I even need to explain this one? The stock was up 31.4% on the day for the session, this beautiful Monday. Basically, there's no fundamental drivers for this stock whatsoever. Yes, Truth Social generates like $3 million of revenue per year, but that's absolutely nothing to justify the multiple billion-dollar valuation that this company carries. Nonetheless, it essentially just trades on pure speculation in association with the Trump brand, just basically trades along sentiment around Donald Trump himself. And since this would-be assassin basically just guaranteed him another term, basically just guaranteed him another presidential term come November, obviously the stock shot up quite a bit, once again up 31.4%. Okay, moving on down below, we have Smith & Wesson Brands. Do I need to explain this one as well, or is this one pretty goddamn obvious for you guys here too? So, Smith & Wesson Brands, in case anybody doesn't know, is one of the largest firearms producers here in the United States. It was up 11.4% for the session for absolutely no reason whatsoever. These stocks, firearm stocks, tend to get more volatile in election years because everybody thinks, oh my God, if the Democrats win, they're going to take all of our guns away. I better go buy one right now. Then they think if the Republicans win, we're going to be fucking selling guns like we're giving out fucking free money or something like that. So everybody gets a little bit concerned or a little bit more uncertain around firearm stocks in election years. And so given that Trump got shot and is definitely going to be president again after that, obviously the stock went higher because analysts are starting to price for less restrictive gun regulations over the next 5 years that could translate into more sales. So that was basically it, or not even less restrictive gun regulations, I guess, but fewer unfavorable gun restrictions. Let's say it like that. Let's go with the double negative there because that'll give me a little bit more safety. Okay, moving on down into the stinky rotten stocks of the day. We first and foremost have Macy's. Stock was down 11.7% for the session because apparently their trip ended. Macy's came down off the shrooms and their consensual hallucination finally finished because the sadomasochists in the boardroom at Macy's just decided that they fucking hate themselves and they don't want to take free money, and instead they want to continue to lose it and lose market share into the future. So the board members unanimously voted to end negotiations with the private equity firms that were trying to take Macy's public at a very nice $6.9 billion valuation. The stock is back on around $4.5 billion in total valuation. That's roughly $4.6 billion too many if you ask me, but still, that's even at a 413x PE multiple if we're looking at the trailing 12 months as well, by the way. So this thing is already ridiculously overvalued. These PE firms were dumb enough to offer almost $7 billion, and Macy's had the fucking gall to say no. I hope they go out of business after that shit, but let's go ahead and move on into our final stock mover. We are talking about solar stocks. Of course, we're going with the ETF 10 to represent this, down 5.9% for the session. Super weird to see ETFs move out of like an up or down like 3% rate. Honestly, 2% is pretty unusual, but nonetheless, this stock fell almost 6% for the session, and there was quite a lot of reasons why. First and foremost, going back to the stuff we've already talked about, with President Trump almost guaranteed the election in November as a result of getting almost assassinated on Saturday, that basically means there's going to be, markets are expecting a higher probability of disincentives to get solar on your house. Or not even necessarily disincentives, but taking away the current incentives, like the tax credits that you get for installing solar panels on your house right now. It's a higher probability that goes away or is reduced. So the stock prices fell across the board. And also SolarEdge came out and said that they're going to be ending the livelihoods of 400 of their employees. It's a little bit less than 10% of their total employee base to improve profitability. Okay, moving on down into our final story of the day. God, I gotta get better at fucking changing these charts behind me. I'm supposed to have this sick-ass Wall Street Oasis logo behind me during this. Nonetheless, we are talking about the earnings spotlight of the day on none other than BlackRock. BlackRock is the largest ass man in the entire world. And by the way, ass man is, of course, the industry-accepted shorthand for asset manager, so get your fucking mind out of the gutter, you dirty freaks. Nonetheless, they're basically the Taylor Swift of asset managers. They're the best to ever do it and also the most hated on easily, and I will happily hate on them as well. Now, they traded like a fucking heartbeat monitor today because nobody knew how to internalize their earnings. Because on one hand, it looked pretty good. On the other hand, it was like, who knows if this is good because we didn't really have any comparables. We do have State Street coming up tomorrow, so we'll get some similar data on flows, and we can kind of assess if BlackRock's issues are a one-off problem or if it's an industry-wide phenomenon, and we can kind of make our determinations there. Nonetheless, it's much less about EPS and revenue beats for BlackRock. Now, they did beat on EPS and they missed on revenue, but it's more about the flow. So that's what we want to talk about here today. You can go ahead and check out the other data in our WSO Alpha piece, by the way. So go click the link in yesterday's edition, or today's edition, I guess. I'm sorry, I don't know what the hell I'm talking about. But nonetheless, the company, they fucking set records on records on records last quarter. So first and foremost, assets under management hit an all-time high at $10.645 trillion. That is a ridiculous amount of money. That is the equivalent size of the entire economies of Germany, Japan, and Australia. That's the third, fourth, and I believe the 11th or 12th largest economies in the entire world. Germany, Japan, and Australia, if you add up their entire GDPs from 2023 or annualized for 2024, it gets to roughly the size of the total assets on BlackRock's books. So an unbelievable feat to even get to that much. But asset like BlackRock, they value AUM more than anything because this is where they're going to be deriving their fees from. So they basically make money by you giving them money and saying, please invest this for me. And they say, thank you, we happily will. And we're also going to take a piece off the top of that. So there's different ways to do it. There's like ETFs have basically expense ratios where they pay for, the cheap little things. There's no fund manager for an ETF. So you don't have to pay somebody to actually pick your stocks for you. You got to pay for shit like the prospectus and distribution and for things like the authorized parties and stuff like that in order to keep the market efficient for these ETFs. But you don't actually have to pay for management. Paying for management is what we call active. And that fell off a cliff for BlackRock last quarter. It didn't really fall off a cliff because it actually increased a little bit as well, but it wasn't nearly as much as analysts had been expecting. So going with the headlining numbers, we saw investment advisory and administration fees grow 8.6% annually, 1.65% quarterly, That is BlackRock's largest revenue segment, growing to roughly the $3.7 billion range. So it was good to see that moving in the right direction. Now, one of the biggest concerns for us, however, was exactly where those were coming from. So that's not supposed to be the end of the slideshow. Shit. Here we go. This is the chart that we're talking about here. If you're listening on the podcast, by the way, go ahead and check out the video as well so that you can see all these charts that I'm yapping about, especially this one, because this is one of the best charts that I've ever made, quite honestly. This is showing in these the dark blue bars is showing the quarter over quarter growth rate for these different line items from BlackRock. So we're talking about retail clients, client assets and ETFs, institutional active investors, institutional index investors, cash, and then the overall total. So overall, quarter over quarter, AUM grew by 1.65%, like we just mentioned right there. Now, if we're talking about some of this other stuff, basically what we're seeing here is the ETF segment of BlackRock and the cash segments are growing by far the fastest. So total AUM in BlackRock's cash management business grew by 4.33%, whereas its ETF business grew by 2.94%. Now, as a percentage of total AUM, ETFs are still the largest. Institutional index funds are next. So that's not necessarily changing up too much, although the big problem here is that if cash management and ETFs are still the fastest growing and the largest kind of portion of revenue going far into the future, those are also the product segments that are going to have the lowest fees. Because what are you going to do? Pay more money for somebody to manage your stock portfolio or to hold your cash for you and like put it in, a slightly higher yielding fund effectively, or buy a bond ladder behind the scenes in order to give you the interest? Which one are you going to pay more for? Obviously, the equity allocation. So they're making less margin on this kind of stuff, so it could be threatening to margins going forward, things like operating and their net margins. But nonetheless, it hasn't really been a huge problem so far. So that's kind of our biggest takeaway. Like I said, guys, we're not giving you all the details and everything that we talk about here today because we are trying to push you guys to go and subscribe to WSO Alpha. In case that wasn't clear, go fucking sign up for it right now, or you're all dead to me. Either way, we'll see how State Street does here this morning when it comes out with its own earnings figures, and then we can actually have a comparable company to decide if BlackRock was good or bad against. Now, we obviously don't care about that whatsoever. We're balls to the wall over here at WSO Alpha, so go check out our piece before you see State Street's numbers. Anyway, let's finish up with some quotes from the CEO of BlackRock himself, Mr. Larry Fink. So we actually have 2 quotes today to show a progression of thought over time. So back in 2017, Mr. Larry Fink, the CEO of BlackRock, said that Bitcoin and all of cryptocurrency was, quote, an index for money laundering. Clearly not a big fan, clearly thinks it's a criminal enterprise, but nonetheless, in 2024, on the earnings call today, he said, quote, I believe Bitcoin is legitimate. Wow, quite the about face, but he didn't stop there. He said, I believe Bitcoin is legitimate. I'm not saying there aren't misuses like everything else, but it is a legitimate financial instrument that allows you to have uncorrelated returns. If uncorrelated returns means fucking crashing through the floor while the S&P 500 is going up, I couldn't agree with him more, quite honestly. But it's all right. I don't need to fucking deal with all the haters in digital assets here. I'm going to go ahead and stop right there before I get myself into more trouble. And please don't call the FBI on me. That was just a joke at the beginning of the video. But anyway, it is now 8:47 p.m. And before I get any other 3-letter agencies investigating me, let's go ahead and call it for the day. Happy investing, happy trading, and we'll see you guys tomorrow. Bye now.